Hi, everyone. This is Rebecca Bundy with Sycamore Lane Realty at Keller Williams. I want to introduce Dustin Barnhurst. Dustin, will you tell us a little bit about yourself?
Sure. So, yeah, like Rebecca said, my name is Dustin Barnhurst. I am a partner at Davies Allen PC. We are a professional accounting firm. We do a lot of tax work for a lot of people in a lot of different states. So, we do tax work for all different types of industries, but we do a lot specifically related to real estate. And so that's kind of who I am. I've been doing this for well over a decade now, so have a lot of experience doing it. And uh, I know I'm kind of weird, but I actually enjoy this stuff. So it's fun. I like the different challenges that come with real estate and taxes, and how to be efficient in paying tax. So.
And that's what we want to talk about today is taxes and specifically capital gains and how it affects you as a property owner or a potential property owner. So I'm just going to dive right in, if you don't mind, Dustin, and I'll start asking you some questions. And if you'll just tell us what the ramifications are, what the pros are, the cons, that way they can get a better idea of what's available for them. Sound okay?
Yep, sounds great.
All right. So first of all, what are capital gains tax?
Yeah, so capital gain tax, it's a separate tax from your earned income tax, which is money you would make as an employee or as a business owner. So it's a little bit different than that. So it's a tax on a gain from when you sell an asset. Okay, it doesn't have to be real estate, it can be any type of asset. So stocks, bonds, mutual funds, it could be a vehicle, it could be art, I mean, any type of asset, right?
Okay.
Um, so that's what's a capital gain, is when you sell an asset that you sell it for more than you bought it for, essentially, right? So your that's what we call your basis, is whatever you paid for that asset. And that basis can change over time, specifically with a piece of real estate, because if you're doing improvements to it or things like that, that all adds to your basis. So kind of the quick way to think about it is sell price less your basis equals your gain. And that's what will be taxed. It's just that gain portion.
Okay. So, so how is that calculated? I mean, you said the purchase price, the basis, and then the capital gain. So how is that calculated?
So once we figure out what your gain is, then the tax on that, I would say for a majority of people, is going to be 15% federal and 5% state, and it's kind of a flat rate. And that's if you're in Utah. If you're in a different state, then your tax will be whatever that state's income tax rate is. Um, but there is a little bit of a tiered system with capital gains tax, similar to income tax, but it's not quite the same as with your income tax. So it doesn't follow the same brackets, it doesn't follow the same income levels. So
Okay.
basically, for an individual, so one person, if your income, your total income, including earned and capital gains, is less than $40,000, anything that you have in capital gains up to $40,000 will be taxed at zero. And if you're married, times these numbers by two. Okay.
Ooh, I
So,
like it. 0 times 2 is still 0.
yep. But then it goes up to 80,000, right? So and then once you're above that, so once you start getting taxed on capital gains at the federal level, it's going to be 15% until you get to the highest tax bracket, essentially. And so that's income of, if you're single, it's right around 400,000. If you're married and you're filing jointly, it's just above 600,000. So once you get to that level, then it's going to jump up to 20%.
Perfect. And just for the ease of the conversation for you and I, well, me, I should say, and so the people listening, we're just going to talk about Utah specifically, since that's the state that I'm currently
Yep,
working in. And I know you do multiple states, I do multiple states, but today we're just going to focus on Utah.
perfect.
So what is the difference between a long-term capital gains and a short-term capital gains?
Yes. So a long-term capital gain is considered anything that you've owned for 366 days or longer. Okay, so a year and a day, essentially, right? That would be a long-term capital gain. And that's the rates that I was just talking about.
Okay.
So to qualify for long-term capital gains rates, you just have to own it for a year and a day, and then you're good. Okay, then you get that preferential tax treatment. If it's a short-term capital gain, it's going to be taxed at ordinary income rates. Okay, which would just be whatever the same rate your W-2's taxed at, or your business income, however you earn income, it'll just be taxed at that same rate. But before they calculate the tax on that, they're going to net out short-term versus long-term gains, right? So if you have like a big long-term loss and a big short-term gain, those two will cancel out before they then apply tax rates to it.
Okay, so there's a little bit more that goes into it rather than just a straight black and white answer. So there are some differences.
Yeah, it's the tax code. There's never a straight black and white answer.
What? Taxes don't have a straight line? Okay.
No, unfortunately, no. But yeah, so because that's the first thing they're going to do is they're going to net out your short-term and your long-term gains. So that's actually a good strategy sometimes that we use for people who maybe they have a big gain on their property that they sold, but they have a bunch of short-term losses from stock or crypto or something like that. So we'll say, hey, let's harvest those losses, offset your big capital gain, and then we can.
That gives you your number that you're going off of.
Yep.
Okay. Awesome. That's actually explained really well. Thank you. Even I understood that. So
Perfect.
is there a difference? Well, let me rephrase that. So is an investment property different than a personal or owner occupied property in a capital gain situation?
So in calculating the gain, most of the time they're similar, right? So the same rules apply as far as whether it's going to be short-term or long-term, right? So 365 days or longer, it's going to be long-term. So that applies to a personal residence or to an investment property. Okay. The one kind of difference that comes in is there is a gain exclusion written into the tax code for your personal residence. Okay. So, and that is if you've lived there for 2 years, so 365 times 2, you live there for that long, then you don't have to pay tax on gain up to your first 250,000 for an individual, and then 500,000 for a married couple, right? So 250 per qualifying taxpayer. Okay, so that's where that kind of difference comes in that a lot of people get kind of hung up on. Is like, well, is it still long term if I haven't been there for 2 years? Yes, it is, but if you've been there for 2 years, there's this gain exclusion that we can get.
So that's the when we go to sell a property, that's when one of the questions the title company asks is, have you lived there for 2 of the last 5 years?
That's
so
right.
that would encompass that answer, correct?
That's
so
right.
if you lived there for the first 2 years and then you've rented it out for 3, that's still considered a long term because you lived there for 2 years.
Yep, and you still qualify for that capital gain exclusion.
Thank you for clearing that.
The one caveat to that would be is if you sold your primary residence, so you started renting it out, right? Then you moved into another primary, then you sold that and used that gain exclusion there. So you can still only do it every 2 years, the gain exclusion. So okay. There may be some timing nuances, but in general, yes, as long as you've been there 2 of the last 5 years, you can get that gain exclusion.
Perfect. And you kind of already answered my next question, which is, will capital gains change your tax bracket? And if it's in the long term, you said no. And if it's in the short term, it could, depending on what that gain and loss calculation is, correct?
Yep, that's correct.
Okay. So would I pay capital gains if I inherited a property and sold it?
Maybe. Okay, so it depends on how soon you sell it after.
Okay.
So when you inherit a property, you get what we call a step up in basis. So when you inherit a property, you get the basis, whatever the fair market value is on the day that you inherited it. Okay. And the IRS actually has a rule that says, and if you sell that property within 6 months of inheriting it, we're just going to treat it as no gain, no loss. It's just basically it was worth the same amount when you received it as when you sold it.
Okay. And that's in 6 months.
That's in 6 months. So
Okay.
let's say you hold it for a year because you got to do some stuff to get it ready or whatever. The only gain that you're potentially going to have would be the difference in the fair market value the day you inherited it and whatever you sold it for.
Okay.
So usually they're still pretty close. I mean, I know the last couple years have been a little crazy in Utah. We've had a lot of appreciation, but still, I mean, sometimes people think, oh, I'm going to take over my parents' basis or my grandparents' basis, whoever they inherited the property from, which isn't the case. You're going to get a step up in basis to current fair market values. So there should be very minimal gains on inherited properties.
Okay. So in that same scenario, if I held it for 2 years before I sold it and it was an inherited property, is there capital gains at that point, or is it still the step up basis of when I acquired it to when I sold it?
Yep, so still step up basis. And if you moved into it as your primary residence when you inherited it, right? Lived there for 2 years and it appreciated more, you still get that
So you
gain
could
exclusion as
exclusion.
well.
Okay.
Yep.
Awesome. So when are the capital gains taxes actually due?
So they will be due in the April following the year you sold it. So if you sold a property right now, you've got basically 12 months before you got to pay those taxes.
Okay. So I can keep that in my bank.
Yep.
Earn some interest off of it, and then pay my taxes as normal.
That's right.
Okay. Or
so they're going to be due basically the April following the year you sold it. So any sales in 2022, you won't pay tax till April 2023.
got it. Okay, perfect. So what if it was my personal residence and I'm selling it after I've been renting it out to someone else? Is that when the capital gain exclusion comes in with if I've lived there for 2 of the 5 years?
Yep. So if you lived there for 2 of the 5 years, so that's important if you're thinking, hey, I might want to exit this property, within 5 years of living there, you want to really make sure that you stay inside those timelines so that you can get that gain exclusion. And the one thing to be aware of on that is when you start renting a property, the IRS doesn't care if you actually take the depreciation on your tax return or not. If you could have, they still count that in their calculations of the gain. And so if you have the exclusion, that's great, but there could be some depreciation recapture in a sale. So it's not super black and white, just like everything else in the tax code. There's a few little nuances, but that's maybe just one piece of caution is if you're planning on selling within 5 years of you moving out of the property, make sure you get that timeline, and then don't do any accelerated depreciation on it. Just stay with your 27.5 years, take the minimal, because there will be a little depreciation recapture, which basically means whatever you took in depreciation, they're going to bring back as income.
Okay.
Is what that means.
Gotcha.
So 1/27th of your basis essentially is what you get to depreciate each year on a single family or a residential property. It doesn't have to be single family, but a residential property. And so just kind of keep that in mind. There could be a little bit of income that's generated, but it would be essentially what you were able to take as deduction in the previous 3 years. So it shouldn't be a lot, but sometimes that catches people off guard.
Okay, that's great information. So is it okay if I include your email in
Sure.
the comments below? That way,
Yep.
if people have questions about what we've talked about or a question that we didn't talk about, that they can reach out to you.
Yeah, that's great. And actually, email is the best way to get a hold of me because I am in a lot of different meetings. So email is the best way to get a hold of me. I do try to respond within about 24 hours to every email I get. Sometimes it's a little longer, but that's really what I try to do. So and sometimes it's if you have a question and it might take a little longer than an email, I'll just have my assistant reach out to you and we'll schedule a time and have a 30-minute conversation. But yeah, happy to help with anything that we can in any way. Like I said, I'm kind of a nerd. I like this stuff. So
Well, and everybody needs people like you that likes this kind of stuff, because the people like me that don't properly understand it can refer you to someone like Dustin so that you can get your questions answered properly without me going, I don't know.
yeah.
So Dustin, is there anything that we didn't cover about capital gains that you want to touch on?
Let's see. No, I mean, I think I think those are the main things that a majority of homeowners or people that have properties maybe don't understand with the tax code. But and if you have a lot of investment properties, I would definitely recommend that you use a CPA to do your taxes. Doesn't need to be me, but just a CPA in general, because there's a lot of different things within the tax code that we can legally do to minimize your tax, and maybe even offset some of your earned income, whether it's from a W-2 or from a business or wherever you're generating your income from. There's just a lot in the tax code that's very favorable to investment properties. So I would definitely recommend that you use a CPA, find one that knows the code, and can help you through navigating those things. There's just a lot that we can do to minimize the tax burden on that, and just make sure that you're set up in a way to pay tax efficiently. And yeah, and I guess one caveat that I'll give people is a lot of times people that do have investment properties are like, oh, I need 1031 exchanges every time, which may not be the best. 1031 exchanges. I know that wasn't on the list for today, and
That's okay.
it's kind of complicated. There's got to be a lot of people involved. There's a lot of specific rules and timelines, but in the very basic, what it is you're exchanging one property and you're going to roll whatever your gains are into another property, right? And there's
So you're
certain
still going
times,
to eventually pay that tax. So determining when the right time to pay that is what you're saying, is whether it's a good idea to use it as a 1031 exchange or not.
That's right. And
Right.
because I had a question from a client just yesterday, and they're like, hey, I'm gonna have a gain on selling this rental property that I've had. It's probably only gonna be like 30 or 40,000. Should I 1031 exchange it? I'm like, no. Like that the tax on that 30,000 is gonna be way easier just to cut a check to the government, pay your 25% tax on that, versus finding a qualified intermediary, paying their fees, just jumping through all the hoops to get that 1031 exchange to defer tax on a $30,000 gain. It doesn't make sense. Just save 25% of your cash and know that you're going to pay it in April next year. So there's a lot of stuff like that a CPA can help you through understanding. Hey, it doesn't make sense to try to deal with all the hassle of going through a 1031 exchange. Let's just pay the tax, know what's coming. We'll set some money aside for it. We'll be ready to go.
And if anybody has questions about 1031 exchanges, I do them all the time, every day, all day long. Of course, I don't understand the tax benefits and consequences. So we can talk about the real estate pros and cons, and then we'll reach out to Dustin so you can understand the tax consequences, pros and cons. I shouldn't say consequences, the capital gains, pros and cons, for if it's right for you to do a 1031.
Yeah. And the good thing is you can always start one and then decide, hey, I'm not going to finish the 1031, and it's fine. So there is some flexibility there, but it's just got to be set up right at the beginning, which Rebecca knows and is well aware of. So yeah. So, and we can help you on the tax side to know whether it's right or not for you.
Okay, awesome. Dustin, thank you so much for joining me today. I really appreciate your time. And I will include, like I said, his email in the comments. So make sure that if you have any questions, you can email him, you can email me. We'll get you set up to communicate the best way to get your questions answered. And then if you guys have more questions regarding this that we didn't cover, please comment below. We will get those questions answered for you. And we are so excited to share this information with you about capital gains, what the truth is behind them, what the myths are. We've myth busted a few of those, because like Dustin said, sometimes a 1031 isn't always the best option. And a lot of people are getting homes inherited to them and need to know what to do with them properly. So Dustin, again, thank you so much for your time. He's with Davis and Allen CPA?
It's PC, but yeah.
Davis and Allen PC. And again, it's Rebecca with Sycamore Lane Realty at Keller Williams. So I will make sure to include our information in the link below, and any questions at all. We would love to find out what more and other questions that you guys have that we didn't think of to share with you, so that we can make sure that you're educated for what you need to do for you. Okay. Thanks, everybody. Have a great day.
See ya.
Bye. I'm Rebecca Bundy, and I just wanted to say, make sure you subscribe, hit the bell button below if you haven't done so yet, and we'd love to hear from you. So whether you like what we're saying or whether you disagree with what we're saying, please let us know. And if there's anything that comes up that you are not getting answers to, that you would like to know about, please make a comment below or request a video and we can put that together for you. And we're happy to help you because we are here for where you're growing next.